Hey guys, welcome back to another video by Fully Informed Trade, or Fitrade for short, knowledge for everyone. My name is Alex Cho, and today I'm just going to analyze the stock market specifically and talk about specific trade setups. First of all, the Dow component has been touching this multi-year trend line, boom, right there, and right there, 3 consecutive times, and we're moving into the 4th consecutive time where it eventually broke above it and is floating right above. Again, nobody can tell you for certain whether or not this market is able to stay above that trend line or if it will break down below it. But if it were to break down below it, which it most likely will, because for all we know, Greece could default by tomorrow morning. Heck, if that honestly happened, I'd be extremely surprised. But, you know, for all we know, something major could happen in the next couple weeks or the next couple months, January, February, or March. And because we anticipate something negative in the near future, stock option contracts on the SPY ETF are pricing in more volatility for the put options than call options, at least in the first 3 months of 2012. Therefore, because we anticipate much more volatility, at least in the short-term future, I could see this market having a hard time sustaining above that multi-year trend line that goes all the way back from the 2007 all-time highs. Therefore, because we're not exactly certain of whether we'll just break right below this, I mean, it could happen with just one move in the US dollar index where it suddenly gaps up and all of a sudden the Dow component sheds like 200, 300 points and we're below 12,400. That could easily happen at any given notice. But we're not exactly certain when that will happen, and therefore it's not a very good idea to be trading the SPY ETF, those neutral ETFs that that move slowly. But it's not good to trade those directional ETFs unless if you have a real strong understanding of of what you're doing, which I strongly doubt. Not because nobody knows what they're doing, but because it's really hard to predict what's going to happen in this market environment. So what's much better is to short weaker or weak tech stocks or weak names in the retail industry or any industry, finding stocks that are underperforming and shorting those. Therefore, you're not as heavily exposed to indexes, or overall we're not as exposed because it's easier to make money off of cheap underperforming stocks that are going to continue going lower. So overall, I do have a negative bias on the Dow Jones Industrial Average, but I'm just not certain when we're going to have this major gap down or a break of that trend line. But once it happens, those directional bets, like those direction FAS, leveraged, leveraged banks, ETFs and stuff like that become easier to trade. But until then, as long as we stay above this trend line, it is going to be very difficult to trade in this environment. Moving on, let's talk about some real trades right now, real trade setups. Again, I was relatively negative on the Chinese stocks. I talked about it in my previous video on, I believe, Sunday night. And right now I'm going over my Monday night video. So, sorry, not my Monday night video. Monday night I was pretty bearish on Chinese stocks, or at least I think it was Monday or Saturday. I'm not sure when I released it. But I'm more than certain I talked about those Chinese stocks. I wasn't too optimistic on them. And basically, my worst fears came true. It rang true. Again, I'm not hoping for companies to sink in price or anything. But, the way I approach stocks is, well, what's the likelihood of it happening? And if it's a very high likelihood, I'm going to trade in a way that accommodates that. I'm not hoping for people to fail. They are already failing, and I'm just taking advantage of what they are already doing. So, again, right now the issue with Chinese equities in this market is that real estate prices are falling. And that's a very, leading indicator, because coming out of the 2007-2006 market bubble, the first indicators of any major bubble is always going to be real estate, because real estate is your primary means of collateral. Whether you go to a bank to borrow money for a business, one of the first things a bank always looks at is your collateral, and basically real estate is a huge portion of that, and it's almost as if it's treated as a secured asset. When the price of property falls, less people, you're able to borrow less money. Uh, you're generally able to borrow less money because the equity in the actual mortgage or the house or whatever it is shrinks. So a falling real estate market is bad in terms of economic growth because everybody is exposed to the property market in some way or another. Um, and how this happens is that people get greedy. They want more expensive. They want to sell their homes more expensively. It makes sense because everybody wants to sell their everybody wants to sell whatever it is they own at the highest possible price. However, because the price has gotten so high, it has become unaffordable for many people to buy property in China. $700,000 for a 900 square foot apartment isn't going to happen anymore. And the main reason why it's not going to happen is because you can sell that same apartment for $250,000 as a developer and still make a profit, The only reason why they want to sell it at a higher price is because they want to earn as much money possible. So what happens is that some of these developers are going to lose money because they borrowed money at perhaps a higher interest rate, perhaps they were expecting higher prices, or maybe they're just going to make a profit. But the real people that are going to lose out, because of developers, you could build a property for perhaps $66 per square foot, and these days in China, they're selling them approximately $300 to $400, $500 per square foot. So the margins are fine for the developers. I think the developers, their issue right now is they're sitting on a lot of inventory and they're not having a lot of turnover on their assets, and therefore that's causing these Chinese companies these Chinese real estate companies to struggle. If they just cut their prices, I don't see developers struggling too much. They might not report as much income as they were projecting, but that doesn't necessarily mean they will lose money. The people that will primarily lose money are the homeowners, because they're the ones that borrowed the money at a higher price, bought it, and now the price of the house has sunk below whatever it is the amount of money they borrowed at, and therefore they have a negative equity. If you have negative equity, you're going to have a harder time borrowing money to start up businesses or to borrow money in general. But the main reason why property is important is because it can be used as collateral for borrowing money from a bank in order to fund your business. That's the main reason why properties are extremely important to an economy. When the value of a home sinks, that means there is less available credit in the economy as a whole, because you have less collateral. And when you have less collateral, that means there will be less economic activity, less investment, and therefore these Chinese tech companies are exposed to a broader economic downturn. Therefore, based on historical evidence at least, in the United States in 2000, when the internet tech bubble happened, we also had a recession, a minor one, but we still had a recession. And it was the tech companies that weren't making any money, that weren't profitable, weren't generating any significant revenue streams. Those were the ones that pulled back the most, and they fell by anywhere from 90% to 80%. We saw something similar happen in Dang Dang already from their IPO price, but it could fall even more because it has already gone up by around 80% in the past couple days. So our exit price should always be around the 20-day moving average. And the main reason why I said the 20-day moving average is because every time a stock pulls back, guys, it always pulls back to the 20-day moving at the very least. It always touches it at some point. For as much as the stock breaks below and falls below that 28-day moving average, every time it gets well extended over it, it always tends to revert back to the average or the 20-day average. It just always happens that way. And that's a good place to cover your position and get and to basically take your profits. So again, I'm still short China e-commerce, China Dang Dang. I anticipate the stock to continue going lower, but I don't plan on holding it below that 20-day moving average, and chances are I'm going to look for other trading opportunities that aren't as volatile anymore, because a lot of the easy money has already been made, but there's probably another 15 to 20% downside in the stock for it to continue going lower, all the way down to around $5.25. Okay, so that could be around a 33% gain, but I'm only looking to make another 15% gain on the short. so that I can close for a total 25 to 30% profit from shorting at around $8.20. Okay, moving on, YOKU.com is in a very similar predicament. And this all comes back down to, the Chinese stocks are exposed to an economic downturn. Falling housing prices will reduce gross domestic product, and therefore YOKU.com will be exposed just as much as e-commerce China Ding Ding. Again, the stock is pulling back. The valuation of the stock should continue going lower and reach at least that 50 to 20-day moving area as a range. And if it were to fall all the way down to that $18 area, that would give you another potential 15 to 20% downside. Even furthermore, chances are I'm going to close anywhere between that 50 to 20-day moving average. I was short at around $23, so I would be closing for approximately 25 to 30% profit on the YOKU.com short, maybe a little more than that, I'm not sure. Moving on, SOHU.com. And remember, I already told you guys in my previous videos on e-commerce China Ding Ding, YOKU.com. I was very bearish. My outlook was very negative, and if you guys weren't paying attention, well, you guys should pay attention more often. SOHU.com. This is another stock that is another internet stock. Again, all comes down to the Chinese economic downturn. Remember, when our IPO boom, or when our internet stocks busted, it didn't matter if you were making a profit, if you were going really fast, if you were a novelty stock and you're doing extremely well. We've seen it in Amazon, we've seen it in AOL.com, we've seen it in Yahoo.com, we saw it in Google.com. Trust me, in a downturn, all tech stocks fall faster than the broader market indices, and therefore I have to be relatively bearish, and there's much more downside on SOHU.com, and I can easily see it going all the way down to $46 per share. Main reason being, it would just make sense for it to happen. I mean, that's what happens to tech stocks. Qihu 360 is relatively flat, but I wouldn't be surprised to see a pullback there as well. Anyway, see you guys later, and I'll talk to you soon.